UNH, a high quality company that I have been buying today, is down 6% after some news that we're about to discuss, down nearly 7% over the last 12 months, and it is heading towards its 52-week low. So is it significantly undervalued? Is it one you should add to your portfolio or consider? And what is the reason for the drop? We're going to find out in today's episode, as well as looking at their top line revenue growth, looking at their bottom line net income. We're going to have a quick look at the health of the company, their cash versus their total debt, and we'll also see how they've performed versus other strong companies in this sector. We'll also take a look at some notable insider selling of nearly $1 million in total, and we'll see whether or not the institutions themselves are continuing to buy quarter on quarter and over the last 12 months. We'll discuss their very safe dividend safety score. We'll look at some financial metrics that does support this, and as always, we will run them through the valuation model so you understand what our intrinsic value is, what is our acceptable buy price given our investor margin of safety, and what are Wall Street forecasts for the next 12 months. Now, before we dive in, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any of the other articles, all completely free, do click on that pinned comment to sign up and gain instant access. So whilst it is down 7% over the last 12 months, if you have been a shareholder over the last 10 years, you would be up a very strong 483%. Do bear in mind this doesn't include those dividends reinvested, and we can see its all-time highs at around $554. Now, it does currently pay a yield of 1.54%, and we do see the forward PE sitting below 18. Now, let's find out quickly why the stock is down, and very similar if you have seen the Humana episode that we have released. Essentially, we can see the Medicare Advantage plans have increased by 3.7% in 2025. Now, this is set by the government. It is something that the companies in this industry, Humana, UNH, ELV, were hoping would be substantially higher than this number. And we can see in particular to Humana, which we have reviewed, one of the issues they felt was that with this very small increase of 3.7%, they believe that the earnings per share targets that they had would not be able to capture the upper end, therefore leaving investors disappointed, not just in Humana but also UNH, which we are reviewing today, as well as Elevance Health, which is also down significantly. So this has really ultimately been something of a negative for these companies, but in my opinion, as we're about to go through, it does look like a very strong opportunity to add this high quality company into your portfolio. So total revenues, as we can see here, $242 billion in 2019. A nice increase to 2023, very strong as we can see. In fact, 50% growth over the last 5 years. And what I like on top of this is that granular increases year on year. And for those that prefer to see the percentages, we'll look back at the last 10 years shortly in that format. Now, in terms of the bottom line, we can see growth every single year. Very nice to note. $13.8 billion in 2019, increases every single year up to 2023. So not just top line increasing, but also bottom line increasing. And if you did watch the Humana episode, you will know, unfortunately, for that company, whilst their top line did increase, their net income was very inconsistent, unlike this company here, UNH. Now, in terms of the health of this company, their total cash versus their total debt, it has increased significantly from $11 billion that we see in 2019 to $25 billion. So lots of growth there. In fact, 2.5 times growth to their cash position. And ultimately, when we do compare that to their total debt, we do see it move from around $41 billion in 2019 to $67 billion. So yes, their cash did increase by 2.5 times, but we also see their total debt, in fact, increase by more than 50%. So something that we will consider when we look at our metrics, in particular the net debt to EBITDA one. Total return then, we've got others in the managed healthcare industry, Elevance Health, Humana, Centene Corporation, Molina Healthcare, and a few others. We can see UNH, total return including dividends reinvested, the second worst performing, in fact only better than HUM, down negative 5.6%. When we extend that to the last 5 years, we do in fact see it as the second best performer, only second to Molina Healthcare as we see. So it has performed fairly decent over the last 5 years, but do bear in mind that past performance is never really an indicator of the future. Institutions, a fair ownership at 88%. Whilst we do see a significant amount of outflows over the last 12 months, we see a significant more, as we can see, in fact nearly 10 times as much. And when we actually look now at Q4, we see more buying than selling, and we have the data available for Q1. Although it isn't the full data, we can see a little bit more buying than selling. So when we take a look at the insiders buys and sells, we did note when looking at both transactions, buys and sells, that there were 2 sales over the last 2 months. We have the chief accounting officer and we also have the vice president, and they did in total sell around 1 million worth of shares. Now, since they sold, the share price has come down negative 12% from the middle of February and negative 5% from the beginning of March. But as always, it isn't a bearish signal, as well, insiders, they sell for many reasons that we aren't aware of, whether that's personal reasons or financial. But again, it is interesting just to note, and we do like to be transparent and show that information. So in terms of looking at the company, the strength of the company, now dividend safety score 99, it is very safe, the highest score obtainable. Market cap 451 billion, it is a mega cap company. Now, in terms of looking at the recessionary metrics, well, last recession, they didn't increase the dividend, but they also didn't cut it. They maintained it. They had plus 5% sales, well above the average, which was around negative 12. And they also trailed the S&P, although marginally negative 63 versus the S&P's negative 55. Now, one reason why I do love this company is that dividend growth. Double digits last summer, double digits on average over the last 5 years, 41% on average if you have been holding this company over the last 20 years. So that is in fact phenomenal, very, very strong. And they have increased the dividends for the last 14 years, whilst paying a dividend for the last 31 without a reduction. Now, dividend yield theory, as always, a company shows undervaluation when the yield is above the 5-year average. So we have that undervaluation signal, and we have a double undervaluation signal on today's episode with the forward P 16.6 below the 5-year of 20. And we do also note is below the healthcare sector P of 17.6. Now, in terms of looking at the free cash flow payout, as always, blanket rule below 60%. Because in my opinion, it means that management have that ability to offer those double-digit increases. Very strong, in fact, below 30% every single year, 24% expected in FY24. So a very positive sign. A bit of a surprise if we don't see a double-digit increase to their dividend in 2024. Earnings data is available. We have it on screen if you want to see, but just point out we do believe it to be susceptible to manipulation by management through accounting. So we draw your attention to the free cash flow, and this is probably nearly as consistent as free cash flow increases get for a company. Very, very strong. They have increased, as we can see here, by around 4 times over the last 10 years, expected to go higher in 2024. So a very positive sign for investors as well as those who are potential investors. Steady moderate growth of 3 to 7%. Well, forget that. UNH, they're bringing double-digit increases to their top line nearly every year, notably over the last 3 years back to back. And that shows when we do look at how their numbers have increased, in fact, nearly 3 times from 130 billion to 372. Now, unfortunately, they don't do a lot of share buybacks, as we can see. So whilst we do like it when companies return that excess cash through the increased ownership that you have of the stocks, we can see they do very marginally over the last 10 years. Now, when we look at the ROIC, Consistency is what I love to see when it is a very good metric. 19% nearly on average over the last 10 years. Absolutely phenomenal. And I do like to see this as an investor. It makes me have faith that over the next 10 years they will produce something similar. Although, as always, we can't rely on that. But it does give me that little bit extra of faith. Operating margin, now look, not the greatest, but it is a little bit better than the others in the industry. As we saw on the previous episode of Humana, this was sitting around 4 to 5%. So around 9 isn't too bad. If they can continue to increase it as they have done over the last 10 years, that would be a positive sign. As we can see, they have done for the free cash flow margin, where it is increasing to around 7% over the last 3 years. Finally, net debt to EBITDA, earnings before the interest, the tax, the depreciation and the amortization. It is below 3, which we can see. In fact, it has been decreasing over the longer term. 2024 below 0.91 expected. And remember, this correlates to dividend safety as well as balance sheet strength. So a lot of positives to take from this company. Now, let's jump into the valuation. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And when we jump into the first model, we have the multiples valuation model. We have companies in a similar sector and size. We have their average PE, multiplied by the EPS of UNH, and we get an intrinsic value which shows an overvaluation signal, so do bear that in mind. But remember, we're not looking at any of these models in isolation. We then have the dividend discount model where we have the increases to the dividends over the selected year. We can see just under 16%. Now we have gone very conservative at 6.75 in today's valuation, and we can see an undervaluation signal, very undervalued based again on this model. But remember, we're not looking at these in isolation. We then have the DCF model with the free cash flow year on year average at 17%. We've gone, in fact, again, very conservative at 7%. So do remember this when we pull it through to the final tab. And we can see, in fact, just over the last year, this increased by 10%. So using 7% with our discount rate, we get the present value of these future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here another undervaluation signal. So in conclusion, we had two undervaluation signals, one overvaluation, and the average gives us the intrinsic value for today's episode of $582. Do bear in mind though, again, we will now apply a margin of safety, and as always, you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list by clicking on the pinned comment below. Margin of safety then at 10%. Remember, we use that if it meets the three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And we keep going till it's near that current buy price. At 15%, a buy up to 495. At 20%, up to 465, which is pretty much near the current value. So it isn't quite a 25% MOS level yet. So for today's episode, based on our estimates, based on our judgments, we are seeing 20 to 25%. Now, personally, this is one that I have bought yesterday and today. It is one that I will continue to buy around this $460 level. I do see it as very undervalued. The metrics are looking very strong, very healthy, and we can see here that Wall Street are forecasting a price of $591 with upside of 29%. Again, they do believe this to be a very strong buy now. But as always, you should do your own due diligence and let us know, though, your thoughts in the comments below. Maybe it's not one you want to add, but you'll add it to your watch list. Maybe it's been one that you have been adding, but we are interested to hear your thoughts as always. Personally though, as I mentioned, this is one that I do like. A lot of very strong metrics that we did run through. I do see this as the market overreacting, and I don't believe it'll be too long before we see these prices as something of a short-term memory. As always though, if you enjoyed the episode, smash that like button, hit that subscribe and bell button as always, and we'll see each and every one of you on the next one.